Hello, friends. My name is Prakash Babu, and basically, I am an assistant professor from Utkarsh Business School, which is located on CV Ganj Road, Bareilly. And today, due to the pandemic we all are struggling with the pandemic, and because of that, most of our classes got most of our schools or colleges have been closed, and due to that, our faculties, they are trying our best to stay connected with the favorite students who want to continue their study. So it doesn't matter if it is not on offline, we are ready to give the education to them through online mode as well. So I'm Prakash here. So let's go ahead with one of my favorite subject called auditing, and I hope this subject, auditing, also favorite to other students as well. So this subject, we are dealing with BCom third year students. So whoever is stay connected with this subject, whoever is online, stay connected with me, so that you get whatever I want. You can get all the information whatever I want to share with you. So let's see. First of all, we'll go ahead with the first unit today, and topic wise topic we have to cover all the all the matter, and this is unit first. We are going to discuss the first unit that we have to deal with, and the basic thing that we have to learn here is auditing. So, meaning and objective. Let's start with the meaning and objective of auditing. So, auditing is an examination of books of account and vouchers of business by an independent person who should be qualified for the job in order to ascertain their accuracy. So, auditing is nothing but an examination of books of account and the voucher of business by an independent person who should be qualified for the job in order to ascertain their accuracy. So, auditing, if we talk about auditing, earlier we have seen a lot of munshis were available. A lot of munshis were providing their services to the shopkeepers, where munshis were handling uh, all the business transactions. They are keeping a track record of business transaction in the books of account. They'll be having a lot of accounts books, where manually these people are entering the business transactions regarding sales or purchases, or number of goods sold, number of goods um, being dealt with, and the inward and outward registers. All this basic information will be kept in the books of account by the munshis. So nowadays it had been so advanced, and people are keeping a independent person in the organization who will be acting as an auditor, whose main job role is to examine the books of account and the vouchers of business by, so that he'll be having a proper he'll be having proper knowledge of the books of account and the business transaction which he is being dealing with, and that particular auditor or a person who has been appointed as an auditor, he will be well qualified, and he'll be having a good knowledge about accountancy and the principles of accounting. So a person who is having this kind of quality or a qualified person will be appointed as an auditor, or we can say an independent body who can, who can give their uh, judgment on part of books of account, whether we talk about the entering the entity entries in the books of account. So he the person who is acting as an auditor here, he will be paid by an organization. So this particular person is having an authority to see whether if it is any fraud or any errors are there in the books of account or not. And if it is there, then it is the duty of that particular auditor to audit, or to get to examine the books of account and to verify whether the transaction have been entered in the books of account are correct or incorrect. If it is any fraud or errors involved in the books of account, then it is the duty of auditor to rectify those errors and find out or detect that kind of fraud, and he can take the corrective measures, or he can intimate the management or higher authority to take the corrective actions as soon as possible. So here we can see objectives of accounting. So basic objective of accounting, of auditing, sorry, the basic objective of auditing is, the first one we can say, verification of accounts and statements. So verification of accounts and statement, this is our first objective. So the second will be detection of errors or frauds. So there will be two kind of mistakes we can find, we can easily track here. The first one is errors and frauds. There is a difference. Errors are, no, the person who is uh, making any mistake, and that mistake is not in his knowledge. So this is called error. A person who is not deliberately doing any mistake, that is called error. So that will be like wrong entries. For example, if if the purchase, in purchase register we have done the sale entry, and in sale entry we have done the purchase entry, and if it is that particular date is not mentioned in that particular transaction, date is missing, and from where the particular stock have been come from, that manufacturing unit name is not there in the register. All these kind of mistakes are called errors, which is which is not intentionally being done by the, on part of the uh, on part of accountant, but it has been done by mistake. So the second one is fraud. Fraud is nothing but a person who is doing it intentionally or deliberately. A person who is deliberately making fraud, or the person who doesn't want his books of account uh, to show the actual picture to the investors or to the government or to the any of the higher authority. So that why I don't want to show the actual picture, because in that case he may not be able to get the loan from the from the banks or financial institution. He may not be able to attract the big investors. So to attract these investors and to get the loan from easy loan from the banks or financial institutions, or to maintain the good or healthy relation with the other party, what the higher authority generally, who is having higher authority in the big organization, they'll be they'll be deliberately they are doing such kind of frauds or such kind of things they are doing, so that they can show the uh, they can show the financial status of the company on a higher side. They don't want to show the actual picture of the company. So this is called a kind of fraud, which is been deliberately done for the purpose of achieving something. So this is like fraud. For example, if someone, some accountant, we can say, accountant has deliberately they have done a mistake. Instead of instead of entering in the books of account 20 quintals of material, he is deliberately is entering 5 quintals of material. It means rest 15 quintals of material where it is gone. So that is again a question mark. So here 15 quintals of material where it has been gone. It has been gone in the pocket of accountant, or maybe a person who is suspicious. So who is answerable for this? So company has to see to that all the answers of this has to be met through the auditor. So auditor has to see whether the fraud or the errors are there in the books of account or not, and if it is there, then it is the duty of the auditor to prevent those errors or frauds as well. So here we can see the advantages of auditing as well. We have a lot of advantages of auditing. It detects errors and frauds with suggestions for their prevention, and to avoid such mistakes being committed, the accounts are kept up to date. So, auditing generally it detects the errors and frauds with suggestions for their prevention. An organization who don't have auditing system, or a person who don't, organization who don't have an auditor in their organization, for that organization, it is very difficult to find out the errors and frauds, and that kind of organization is no, they are running they're running their business transactions, but it is not actually uh, it can't be say that it we can't say that they are running their business, they are running the fair business actually. So fair business is the business where actually all these things happens, where auditing exists, where auditor doing their job role, and auditor performing their job role. There we can say the fair business happens. The second one is to avoid such mistakes being committed, the account are kept up to date. So to avoid these kind of mistakes, like prevention against the fraud or errors, to avoid these kind of mistakes being committed, the accounts are kept up to date. So account has to be up to date. It is not like that out of date account is there. If it is not mentioned any date, or it is out of date, so it is the duty of accountant to keep it up to date. So regularly the books of account has been verified. It has been regularly examined. Analysis had been done by the auditor. And the third one is the parties feel confident of audit report because it was done by an independent person or body. So parties, whoever is there in the organization, who are dependent on the books of account, they feel very much confident about the audit report. Why? Because the audit report has been prepared by the independent person or the body who has been appointed as an auditor, or who has been given an authority to audit on behalf of the organization, audit the books of account on behalf of organization, and he can take the initiative or decision on behalf of organization as well. So this is independent body who is not differentiating, who is not doing any partiality between any of the member of the organization. He is doing his job very well. And the fourth one is accounts are audited stand authentic. So the account has been audited, they stand authentic itself. And the fifth one is the auditors are competent person in the fields of account and financial laws, so can render advice to management. So as we have already talked about this personalities, that personality of a particular auditor, who has already been competent person, who is already been talented person and already qualified person, who has already qualified in the field of accountancy. So he'll be having a lot of knowledge about accounts and financial laws or financial statements. So a person who is having that kind of sound knowledge, definitely he'll give an good advice to the management. And the sixth one is, in case of joint stock companies, the director has no chance of taking undue advantages. So in joint stock companies also, few of the director who has on his side, few of the director, the what they do is they take an advantages of their chairs. So what will they do is, whenever any decision, major decision comes, these director take an advantage. Instead of instead of following the auditor's report, these director do the partiality and they'll take their own decision. So in case of auditing, this will not happen. Even the director has no chance of taking undue advantages. So he has to depend on the auditor. And the seventh one is, auditing account facilitate settlement among partners. So auditing accounts also facilitate the settlement among the partners. If it is the partners are there in the company, so proper settlement will be there between them. So there will be no partiality, there will be no differentiation between these partners. Equal and fair chances will be given to all the partners, and it will make sure that all the partners are benefited. No lot, no profit will be there between the partners. Thank you for today. uh, we'll come up with the next topic as soon as possible. And thanks for today. Thanks for joining today. Thanks a lot. Keep in touch with me, and if it is any query or any kind of doubts, you can clarify with me, or you can leave a comment in the comment box, or you can personally contact me on my official WhatsApp number 6397 635767, or you can leave an email to me at pgprakashgang@gmail.com. Thank you for today. Let's hope we'll meet up with another meeting very soon. So stay in touch with me, get connected, and thank you very much. Thanks. Thanks a lot.